Hello and welcome to the review looking back at the events of November and bringing things up to date as we approach the end of this year. We concluded our office move earlier this month and we now reside at our new address in Cheviot House in Castle Street in Salisbury, but our contact numbers and email address remain unchanged. Our Christmas dates are now confirmed. We'll be closing on Friday the 21st of December, reopening on the 3rd of January, but as usual we'll be monitoring email, voicemail and investment markets during this time, just in case anything needs actioning. With regard to news events, I delayed sending out this report so that we could provide some bullet point commentary on the autumn statement, which was delivered by George Osborne on the 5th of December. There was some news regarding economic growth in that the forecast predictions for growth have been downgraded from 0.8% to minus 0.1%. Also some news affecting pensions. From 2014-15, the lifetime allowance is to be reduced to 1.25 million, and pension contributions that can attract tax relief, well, they're being reduced also from £50,000 to £40,000 each year. The pension drawdown income limit is set to return to 120%. No date's been set for this yet, but we think this could be advantageous to lots of our clients who are using pension drawdown. The inheritance tax threshold is to be increased by 1% next year, and I hope next month to be able to produce for you a more detailed summary once we get more information through, because as yet we can only get information on a summary basis from the government. In the last review, I touched on the subject of some changes that are happening in our industry, and you'll probably see quite a lot of this in the press, especially in the run-up to January. The changes are known as the Retail Distribution Review, and we refer to this as RDR. And it was set up by the FSA with the aim to improve clarity for people who are looking to invest, raise the professional standards of advisors, and reduce the conflict of interest which is found in remuneration for advisor services. By stipulating new professionalism requirements, it's intended that the level of consumer confidence and trust in the retail investment sector as a whole will be improved. Well, our business model has been ready for these changes for some years, in fact, and we see the impact of RDR in a very positive light. We like to think of ourselves as a well-established company, and we will simply continue to provide independent advice and a high level of service that our clients have come to expect over the years. We've always placed our clients' needs foremost because they, the clients, are the cornerstone of our business. Our advisors, and indeed some of our support staff, have all gained the requisite qualifications and will continue to maintain these high standards with continuing professional development. I'd like to assure you that although the changes arising from RDR come into effect from the beginning of January next year, our existing clients will see no changes. They will not be asked to agree to a complicated new fee structure for our continuing service because continuing service arrangements were put in place when investments were initially made. For any new clients that we undertake business for, we will be remunerated by a mutually agreed fee to ensure that we're fairly recompensed for our work and that our clients receive fair value for money as well. The charges for our services have always been transparent, and that will continue to be the case. Could you please take a moment to read our new terms of business by clicking on the red text here, and this should then redirect you to the web page for this. And if you've got any questions about this, please feel free to call us. To give some consideration now to the economic outlook, the main developed economies continue to repair their balance sheets, which will inevitably lead to an extended period of slow, real growth. Inflationary pressure should keep interest rates low for the foreseeable future. That's okay if you're borrowing money, but perhaps not so good if you're trying to get a return on your savings. We're still monitoring the position regarding interest rates and their possible impact on the corporate bond funds that are held within many of our clients' portfolios. If there do need to be any changes, of course, we'll notify you straight away, but as things stand, we're quite happy with the shape of most portfolios. Looking at the USA, the threat of the fiscal cliff remains. It's hoped that some compromising action will be taken to mitigate the effect of expiring Bush legislation in January 2013, Automatic tax increases and spending cuts could weigh heavily on growth, possibly driving their economy back into recession. But cancelling them would lead to the US debt growing further, which is also unsustainable. At the time of writing this review, talks are still ongoing to find a solution, but it's clear that an agreement needs to be found. Turning now to Europe, it's evident that the crisis is being worked through, with austerity measures in Ireland and Portugal now starting to show signs of improvement in their debt reduction, growth predictions and falling bond yields. Agreements have been reached in the Greek Parliament to include a debt buyback and an interest rate cut on loans, which will keep Greece afloat a little bit longer, but it will still have to implement some fairly unpopular reforms. Spain has officially requested a bailout for its banking sector. New leadership in China is showing resolve to tackle disparities between the rich and the poor. Over half of the Chinese population are now urban dwellers, and this migration from the country to the towns is helping to raise people's living standards and generate growth. But of course this has an impact on environment, food and healthcare services, for instance. HSBC data shows that the Chinese economy continues to recover from the effects of the global slowdown, and growth forecasts in a recent OECD report predict that China's global gross domestic product will increase from 17% now to a massive 28% by 2030. Of course, no investment review would be complete without a chart, and in this chart we've looked back over the previous 12 months just to give consideration to the FTSE, the middle range investment portfolios applicable to investment bonds and pensions, so risk rated 5, and we've compared those against the UK retail price index and also the very bottom line, the probable cash returns that one can achieve in a savings account. Just to add a little commentary to the previous chart, it's pretty clear from the chart that cash just doesn't offer a return. Deduct inflation from the flat line that represents the ING savings account and clearly returns are negative. Cash therefore is our benchmark, because if we're not invested in one way or the other, then our only remaining option is to invest in cash. It's also apparent that each of our highlighted general portfolio constructions are less volatile than the FTSE 100. We would risk rate the FTSE as a 10 out of 10 using our risk scoring system, and so we're not surprised that in buoyant times it outperforms portfolios of a less risky nature. In the last report, comparisons were drawn against a risk factor 8. This time, risk factor 5 portfolios are being compared. You will see that the FTSE 100 has been particularly volatile over the last year, whereas the return from our medium risk portfolios have shown a much more comfortable ride. And this demonstrates the benefit of diversifying our investments with exposure to different asset classes, different geographical areas and fund managers, all of which add up to smooth out overall investment returns. So to bring this review to summary, I do think the volatility will continue. Therefore, anyone invested directly in the markets, the way that most of us are, is going to experience ups and downs for the foreseeable future. We hope that our risk-rated investment portfolio strategies will continue to provide all of us with a less bumpy ride. Obviously, we will continue to keep abreast of affairs, but in the interim, if you'd like to contact us, please feel free at any time. No charges will apply despite what you read in the press, because it's all part of the way that we work with you. As usual, our contact details follow on the next page. Also at this point, I'd just like to wish everybody listening a very Merry Christmas and all the best for a successful, prosperous and healthy 2013.